All right, welcome everybody. My name is Brad Bernthal. I'm the Director of the Entrepreneurship Initiative at our Silicon Flatiron Center on behalf of CU Boulder, Colorado Law, and Silicon Flatirons. Welcome to campus for our crash course on mergers and acquisitions. Really excited about this tonight. Want to say a few thank yous, preview the evening, and then we're going to have an opportunity if you are in the space for an announcement, upcoming event, looking to hire, etc. There's a chance to do that. We'll take a break and I'll introduce Adam and we'll get the keynote underway. In terms of thank yous, I want to make sure to highlight our Silicon Flatirons team. I get to do a lot of talking, but they do most of the work. I'll start with our Executive Director, Amy Stepanovich. If you've not had a chance to meet Amy, she's done a fabulous job this year and is coming off a Bravo conference that she put together in February, our flagship conference. Next to Amy is Vanessa, who's our events director and really makes the wheels stay on the tracks for things like this. You get a chance to give her a thank you. Please do. If a hug is welcome, you can ask her and do that. Anybody else? Is Heather outside? All right, so Heather Martin's outside, core to our team. Please tell her thank you. And we've got a slew, and Nate just came on as well to the team. Nate, welcome to Silicon Flatirons. And then we've got a slew of students who are volunteering. Students who are here? Volunteers? All right, so they're outside. We'll get them in here. And at the reception, I strongly encourage those of you who are entrepreneurs and professionals to tackle a student and meet them as part of the networking. In terms of our crash course series, how many of you have been to a Silicon Flatirons crash course before? All right, so about 3/4. How many people are here on the campus already? Students, faculty, staff, community? All right, I thought it might be helpful for the panel and our keynote to also know how many of you have been part of an M&A deal from either the business side or as a service provider in the past. All right, so you got to pitch to a broad audience in terms of where we are. Okay, so I want to say a couple things. One is very personal, which is I'm not going to have a chance to do much in the way of introduction after Adam's keynote, but I want to thank Mark Kurtenbach, who is here and really was a core architect of tonight, Eric Lentel, who flew in from San Francisco to be part of tonight's event, and where's John Sargent? And John Sargent, who's a partner over at Frascona Joyner. Why am I singling these individuals out? I have now been at CU Law for 15 years. And there's an old saw in teaching that the first year that you teach a class, the professor learns the class. The second year, the students learn it. And the third year, everyone gets bored. I can tell you that that first entrepreneurial law clinic that I was a part of was not a well-oiled machine. And John and Eric and Mark were the individuals who put oars in the water, gave me feedback, really bought in and helped build the clinic. And if we get a show of hands for people who are alumni of the Entrepreneurial Law Clinic, supervising attorneys, or are currently involved, you're going to see that there are a lot of people that this has touched over the years, and I am grateful for what you guys set in motion. Please give me a round of applause. Thank them. All right, in terms of where we're going, after announcements, I'm going to introduce Adam, who's going to do a keynote address. And from there, we're going to have a panel discussion followed by Q&A, and then we'll have a reception next door. So that is where we are going. Let me stop and invite any announcements of upcoming events that are relevant, whether it's in the community. Hey, Matt, how you doing? It'd be kind of fun just to, hey, I'll just introduce. Announcements of people in the community, upcoming events, people looking to hire, other things for the public good. Who's got an announcement? I've got a few things up the sleeve in terms of Amelia. You want to talk about the New Venture Challenge? Do we have a microphone moving around?
Oh, is this on? Yay, okay. Hi, everyone. I'm Amelia. I am one of the track leads for the New Venture Challenge, which is this huge competition on campus where student groups get together, they start creating a business or maybe have created a business prior to the competition. And then they get up and they pitch in front of complete strangers, investors, their peers in the program. So it's amazing. It's so much fun. It's a ton of energy. We just had round 1 on the last 2 days, and we have 30 of the best teams out of 130 teams moving forward to round 2, which is on March 12th. It's going to be a ton of fun, and then from that, 6 are moving on to the championships, which I believe is April 7th at the Boulder Theater. It's a huge event. It's a ton of fun and really high energy. It's a lot of the heavy hitters in the community and just really great to be involved. So if anybody wants to talk about it, please find me.
Thanks. Really easy to recommend. This is sort of a cross-campus miracle. This platform serves everybody on campus, undergrad, grad student, staff, faculty, all corners of the campus. We started with 150 teams this year that indicated interest. By the time we get to the Boulder Theater, it's the top 6, and it is a really good show, so easy to recommend. Other upcoming events or people who are looking to hire or other community announcements? Maybe not a great sign of the economy that there's no announcements along those lines. All right, take a minute, find somebody sitting in your vicinity that you've not met before tonight, introduce yourself, we'll reconvene in 2 minutes and get going. Okay, this is the hard part. Try to break up conversations. Shh. Shh. I got to thank Robert Rich for that technique. If you ever have trouble bringing a group together, the shush into a microphone strangely works. All right, delighted to be introducing our keynote address speaker who is Adam Haynes. Before doing so, I want to give a special thank you to both SRS and GLC advisors and Hogan for helping sponsor tonight's reception, so to the extent that the food and drink is welcome, thank them. Adam is Managing Director at GLC Advisors, where his experience includes having done 75 mergers, $16 billion worth of mergers. Before GLC Advisors, he was one of the principals at St. Charles Capital. One question, how many sleepless nights in terms of transactions?
Quite a few. Not as much as the attorney, but quite a few.
So please help me give a warm welcome to Adam Haynes. Thanks for being here.
Thanks for that introduction. I've just got a 10 or 12 minute quick update on the M&A markets. It's all from a tech, so I've been a tech maker my whole career, so my lens is technology and really software. I am with GLC, middle market advisory firm based out of New York, office in San Francisco. There were 5 of us 4 years ago in Denver. There are 15 of us now, and we actually are hiring. So like we did at St. Charles, we would like to build out our capabilities in various industries beyond technology, business services, healthcare, and financial institutions. So If you have a resume, we would love to look at it. As far as technology goes, these are a smattering of the various names of companies that we have represented, technology companies in the state of Colorado. A lot of them are Boulder-based, all the way down to Excelos down in the Springs. Very excited about the evolution of the technology world in Colorado from 2005 when we founded St. Charles Capital to today. There's a ton of money that's come into the state, a ton of private equity that's come into the state, and a ton of venture capital as well. So these are hopefully some household names. I'm sure people know Conga, which is a wild success for Insight Venture Partners that we did. Wall Street On Demand was a nice Boulder startup here that still employs a number of people here in town. So let's get past the commercial. So I like to start with the answer first. It's the ADD in me. There's a ton of private equity, dry powder, trillions of dollars, and they continue to raise money, and I'll hit on that at the end of this presentation as well. Strategics have even more, 2.4 trillion in cash. Software is an incredibly capital efficient business model, as you would see with Apple, with hundreds of billions of dollars on the balance sheet. And these companies are looking constantly to, it's almost it's waving the white flag if you're a software company and you're publicly held and you declare a dividend. Because it says that you don't have new, cool, innovative things to put money into under your own tent. And so companies are hoarding that cash, and they do a lot of mergers and acquisitions as a result. This lower left is a little troubling. This is a leveraged stat, so about 5 times. This is just all middle market deals, not just tech. We have seen tech deals go for anywhere from 7 to 11 times leverage, which for the commercial bankers, Eric Long, is really frightening. We've never seen that. So the credit bubble is something that we'll probably talk about here as well. And then the influence of private equity on tech M&A has been massive. You had a lot of these smaller, the Franciscos and the TAs and the Summits grow, and then they have to calve off smaller funds, and then those smaller funds have to calve off even smaller funds just to keep up with acquisitions. So we're in the middle market, so that's, call it 25 million to 250 million in enterprise value. And so the majority of the companies that we're selling aren't going to IBM, Oracle, SAP, Google, Facebook. They're going to private equity-backed strategics who have purchased a platform and are rolling up as fast as they can to create these big companies that then get the eye of Oracles, IBMs, SAPs, that sort of thing. Broad market indices, so this top outperformer is the Nasdaq. Obviously, technology, because of the capital efficiency, is a very good place and has been a very good place to put your money from a public equities perspective. So certainly outpaced. The other 2 lines are the Dow and the S&P 500. And then when you take that Nasdaq index and break it out, we've got the Nasdaq 100 Tech Index. We have just a general software index. We have a tech services index, but that one that has outpaced everybody else, the light blue, is the SaaS index. And I won't preach the beauties and merits of the SaaS business model, but it's kind of that software, create it once, sell it multiple times on steroids. So that's it. It's a little crazy, the valuations right now. I think Coupa in the supply chain world is trading at like 27 times revenue, which just doesn't make any sense. But they've been very successful, and there's been a lot of money thrown at SaaS companies. So this is the blue bar is the 3-year average revenue multiple. The current trading multiple is the gray bar. So you can see the grays are generally trading higher than the average over the last 3 years. Naysayers, which is not what an investment banker is paid to be, we're paid to be optimists. A naysayer would say this is a peak. Things are so frothy that even over the last, and we've been in a bull market for 10 plus years, which I'll show you. These are high, lofty valuations. So we break these in, and it's really irrelevant here, but we break them into what these people are doing, what part of software, whether it's supply chain or fintech or HR software, that sort of thing. So this is the bull market. So you had the dot-com on the far left, and it was crazy. And we have yet to get back to the deal volume, which is that blue bar. And then you had the big contraction, the recession, 01, 02, and that was all of a couple of years. And then we got crazy and the pendulum swung right back to euphoria, all the way right into the housing contraction, and that was all of 2 years, letting that steam out. And right now, we have had 10 years without a lot of steam being let out of this market. There has been a tremendous amount of capital that has been generated through profitability, through people selling their businesses and coming into hundreds of millions of dollars and investing back into private equity. And those private equity people have to find operating businesses to invest in, and that's reflected here. So you can see in, I think, 17, these are EBITDA multiples, the jagged line there, and it was very euphoric as far as the EBITDA multiples that businesses were selling for in 17. So it has been 10 years, and it has been uncomfortable for a number of years for a lot of people who do this for a living. But the capital keeps coming in, and unemployment is low, and we can get into macroeconomics. But really, there doesn't seem to be an end in sight. But now that I've said that, I'm sorry that I said that. Middle market debt multiples, again, really large debt that's being put on software companies. A lot of private equity companies are putting leverage on the acquisitions that they make, and then they may do a debt recap within months afterward to quasi-pay themselves back. And as long as the credit is there and the banks are providing it, they will borrow. This is a really interesting chart. This kind of purplish thing is the listed strategics. It's a proxy for strategics. And the blue is private equity. So looking at tech deals, a couple of years ago, you can see that in 2017, that's where private equity began to buy more tech companies than the tech companies were buying. And that's a pretty interesting statistic that we've seen. And then this just represents deal value and the number of deals. So deal volume came down last year, but the number of transactions, 1,100, is still the second largest in the last 5 or 6 years. So private equity is extremely active in technology. I promised I'd come back to the private equity calving off. So a lot of these are big household names. Most of in fact, all of these have portfolio companies in Colorado. And then off to the right, so Excel KKR at the top, long-term capital fund, is their smaller, it's actually their partner's capital. Because you keep raising all this money, but you can't, so Francisco needs to write, you can see on the top here, $200 to $250 million equity checks. Those are big companies. And there just aren't that many, right? It's a pyramid as far as the big companies at the top, and then all this middle market and these smaller companies at the bottom. So Francisco breaks out into an agility fund looking to write $20 to $75 million equity checks. Vista is a great example of that. Big Vista, the most highly successful private equity firm by whichever third party ranks these shops. Vista came out, it was almost a hobby, I think probably 7 or 8 years ago. The foundation fund, it was $400 million. They were very successful. They had to raise $1.1 billion, very successful. They had to raise $3 billion plus in the most recent incarnation. And so they had to calve off into an Endeavor fund, which is another smaller fund behind the small fund. And that's looking for businesses with 5 to 10 million in revenue, which frankly is the majority of businesses in tech out there. So that's all I had as far as overview of the market. We can lead it to questions or we can jump right into the panel.
For the end, because we have a Q&A session coming up as well. So thanks so much for that presentation. Probably just turn it off, hopefully. Here we go. I think Adam's spot on in the continued growth in the technology sector from an M&A perspective. I think what we're going to hear today, from the panelists is whether there are headwinds. Is it the coronavirus? Is it the upcoming election? Is it the regulatory environment that's faced by not only tech companies, but really all buyers in the market in terms of getting clearances under antitrust or under CFIUS or other challenges. And so I think the question for today is, are there headwinds? Because we're on record growth, and I'm really excited to be able to introduce this impressive panel. Each of them have sort of cross-disciplined expertise, which is intentional. So whether that's financial expertise, legal expertise, and the like. So first, next to Adam on his left is Eric Lentell. Eric is the Deputy General Counsel at Fitbit. Eric is a law school classmate of mine here from CU. And has had a really interesting career, largely in-house, representing tech companies, and a lot of things operational. Eric will have an interesting story to tell about where they are in the transaction for Fitbit to be sold. Fitbit is a public company right now, and is under contract to be sold to a much larger tech company. And so I think he can add an interesting perspective. I would also just ask, there are probably things Eric can't talk about the transaction or about the regulatory environment, so I'd ask folks to be respectful of that. Next to Eric Lentell, we have Eric Martin. Eric is a lawyer by training, graduate of DU Law School originally, but now is with SRS Acquium. For those of you who are not familiar with SRS Acquium, SRS is a shareholder representative services firm, and they do related escrows and other things to help facilitate transactions. And so brings an interesting perspective, in a lot of ways looking from hundreds of deals that they see in their capacity, and being able to bring a real market perspective as to what the market looks like for M&A transactions. To the left of Eric, we have Jackie Rodriguez. Jackie is a deal advisory director at KPMG, so a financial reporting and accounting expert in the M&A world. She specializes in both healthcare and life sciences transactions. So two other really, really important industries, not only for the state of Colorado, but for Boulder as well. So her expertise lies in quality of earnings studies, working capital adjustments, and other really important numbers things, which scare the law students in here, I'm sure. To the left of Jackie is Chris Wygand. Chris is a colleague of mine at Hogan Lovells. He has a broad-based M&A practice representing anyone from strategics to private equity firms in cross-sector, cross-industry, transactions, both public and private M&A transactions. He works with me on a lot of live music and entertainment deals as well. So that's our panel. We'll dive in just a minute. I think maybe I'll set the stage a touch to bridge from where Adam brought us on the macro level of M&A, technology M&A, as to why are we here in an entrepreneurship setting. What does M&A have to do with it? It's obviously the end game, but as you think about a lot of the entrepreneurship efforts that have been, that we're all involved in here at CU, there's a lot of discussions and panels about investment capital, growth capital, venture capital, all of which is not what M&A is. In fact, those are all steps to hopefully build a company to a successful point where you can obtain liquidity as either the founder or the early investors in that. And so in contrast to capital raising, M&A is usually a transaction where folks are exiting, obtaining liquidity, and new buyers are coming in to take over the company and to take it in a different direction to build it where they want to go. Anecdotally, and I think this came off in Adam's comments, VC to PE exits are at an all-time high, which shows you that a lot of venture capital backed companies are exiting instead of going public these days, or exiting to private equity backed companies, which then obviously exit to more private equity backed companies, and eventually may end up in IPO. But you see a traditional path there that's been extended in a lot of ways by leverage buyouts and other buyout activity in the tech space. So what is the M&A ecosystem, and what do we play in it? I think one of our goals here, especially because we have students, is sort of demystify some of the verbiage around M&A to make it easy and accessible. And we'll try to do that by addressing any questions that you may have, and also trying to explain things. So in the M&A ecosystem, there are targets. Those are usually the company that is being bought or acquired in the transaction. There's sellers in a transaction. They're the founders or the investors or the other people who are obtaining the liquidity, losing control of the company, but obtaining, hopefully, extraordinary wealth in doing so. There are then buyers of the companies, and those come in multiple flavors, and Adam shared with you some of those flavors. I mean, The traditional path for technology-based exits was to sell to a strategic. What does that mean? Some people probably don't know the difference between that. That's essentially a company that's already in the technology space, an operating company, the Apples of the world and other players. Those are referred to as strategics in the M&A landscape. There are financial buyers. Those are most commonly private equity firms. Those are folks who are raising money from their limited partners to buy and sell companies and return capital to their partners. They're not otherwise operating in the space. But there's a huge mix of those because financial sponsors own strategic companies. And so you'll often end up in a situation where you say, well, you're selling to a strategic, and the answer is yes. But that strategic's really owned by a financial sponsor, and so you have this mixed bag of who you really sold to. So the data is a little hard. So that's what the world of buyers are. Then there is the world of advisors, and a number of us serve that role of advisors. I'm a lawyer. Jackie's a financial advisor. Adam, is a sell-side investment banker advisor. Eric Martin is a shareholder representative advisor. All these people build the ecosystem to help advise to do M&A transactions in the market. And so I'm pleased we have such a diverse group. So what kind of transactions are there? There's public company transactions and there's private company transactions. That just means what is the target? What's being bought? If it's a public target, it's called a public company transaction. And if it's a non-public company, it's called a private company transaction. The vast majority of transactions in the United States, and particularly in Colorado, are private company transactions. And so I think we'll focus our efforts there. Public company transactions are interesting in the source of law school textbooks and fancy things like go shops and fiduciary duty outs and other topics. I think we'll largely save those for another day and focus on really the sale of private companies in the range of 25 to 250 million. Actually, middle market's a funny word because that's one definition, but I see it defined at 10 million enterprise value to $1 billion. And those are huge, vastly different transactions. But I think we will focus in the middle market, however you want to define it. I think my last comment before we dive into the panel is to talk about proprietary versus non-proprietary transactions. Huge distinction in the market as to what those two things are. So a classic case of a proprietary transaction is essentially a singular buyer is engaged with a singular seller to acquire a company. They have not gone out to a broad-based auction process. Instead, they've entered into what's essentially a transaction between two parties, and they'll negotiate to finish it without testing the market or broadening the market. Some buyers, particularly private equity buyers, love to get in proprietary transactions. It's usually a beneficial situation. It costs a whole lot less to execute, and that's a good result for some sellers as well. You can execute fast. You don't have to deal with a bunch of parties. You don't have to tell your secret sauce. On the other end of that, there's what Adam does for a living, what I do for a living, what Chris and a lot of other people do for a living, which is to help people participate largely in non-proprietary processes. That is essentially a seller going to market with its business in order to be able to sell it and engaging dozens sometimes or more potential buyers and prospects in evaluating the company and doing a due diligence exercise. Eventually whittling that down to a handful that might get serious about it, spend a little bit more money and time, and then eventually maybe signing with a singular party. And so I think we'll spend a lot of our time talking here about non-proprietary transactions in the process of selling companies and being involved in those on a buy side. So that's hopefully a good ability to sort of set the stage, and we'll dive into the panel. What we've done here is set this up in sort of deal chronology. So a lot of you said, hey, I've been involved in an M&A transaction. We're going to start at the beginning. And in about an hour, we're going to be at the end of the transaction. And so sort of at the beginning of the transaction itself, it's really all about a seller wanting to sell, whether that's a private equity firm wanting to sell, a venture capital firm, or the founders wanting to sell, whoever's in control. They probably walk into your office first, Adam. What do they say, and what are they looking for besides just money?
They're looking for money because they've been throwing themselves into these businesses, and these businesses have either provided a good income for them, or more than likely, it has been an okay income, but really they're building enterprise value. So what do they say? They say, what is my business worth? right? How do I judge what my business is worth? They're publicly traded companies. Am I similar to these companies? And we can get really deep into that. But what we tell people is, try to, if you can, pull yourself out of the business and look at it from the outside. And is it a valuable business? If you were buying a business, is this a business that would attract you? Have you created barriers to entry? Is there a special sauce? So people are very curious about, that they will come into our office and say, this is what we have. What do you think about what we've built?
And that can be widely different thoughts. Sellers will, at least in my experience, interview a number of potential advisors. Usually it's, bankers out of the gate. Eric Lintel, as a sort of serial buyer in the market, when you start looking at targets, how do you judge when to be serious or not, and how much time and effort, and when do you really engage as a serial buyer in the process?
Type transaction that we're looking at, right? We're analyzing it from a financial perspective to say, how long would it take us to build it? How much would it cost? And can we build it, right? So a lot of times when you're in-house at a company, that's really the first thing that you're looking at is, do I need to buy this or could I build it? So that's typically the exercise we're doing first at a senior management level to say, okay, I need XYZ asset. How long would it take me to build it? How much would it cost? And does it exist in the market where I could go potentially acquire it at a cost that's better and quicker than for me to build it? So that's typically the initial stage of the conversation. A lot of times it'll be because we're working with someone already in a commercial relationship, and it will morph into something and say, hey, look, that makes sense for our business, and can we get it at a price that makes sense to buy versus build?
That makes sense. Jackie, I think one of the things that we see in at least my role is the company ready to be sold? Could you maybe walk us through it from your perspective, what good sellers may do to be financially ready to be sellers in a broad-based auction?
Mm-hmm. So when you're getting ready to sell, people are going to ask you for a lot of information. They're going to ask you for a lot of questions. They're going to ask you for a lot of data. Typically, you're going to engage a financial diligence provider to assist you in understanding the data that you have, how that data trends, and how that coalesces with the story of your business. Ultimately, what I see is that you're getting valued on a multiple of your normalized earnings. So you need to understand what normalized means. That's why you're hiring a financial advisor. We go in there, we analyze the data, we look at the trends of your revenue, of your volumes, and we identify things that might be non-recurring or unusual that you really want to pull out and understand what you are looking like on a normalized basis. Because ultimately, that's what you're going to get paid on.
Yeah, super interesting observation. I think most of you probably know that already, but most businesses are sold outside of the tech industry on multiples of EBITDA. I think Adam shared some of that. Adam, any commentary about sort of tech and tech multiples and revenue versus EBITDA, just where you're seeing it?
Sure. Yeah. I mean, and by the way, we won't take a company to market without a good quality of earnings.
Yes.
To have some, because as you're preparing to be sold, you need to anticipate all of the pushbacks from somebody. And a lot of it is around your financials. So a lot of the work we do with our quality of earnings partners is look at the revenue, do a big customer contract database. So much of a software company is valued on recurring revenue. So you need to look at that recurring revenue and poke as many holes in it as you can. Do people buy? What are the dynamics? This guy's been my client forever, and every time I increase my prices, he re-ups it or adds more users. That's beautiful. Somebody who turns it off and then turns it on, that creates churn. And so your retention looks a little ugly, and we need to figure out why that is. We'll do cohort analysis. So you have and I don't mean to throw out crazy terms, but you may have these really happy clients in 08, 09, 010, and then you did a product upgrade and that cohort churned because that new product that you released out there angered some people. It was either confusing or it lost some functionality. People got comfortable with it. Now you've changed things on them, and that's the beauty of SaaS. And so maybe they churned out. So we do a ton of that work because it is often a revenue multiple that you will get paid on. You will get paid a revenue multiple if your revenue is growing. People will value growth, and so maybe there aren't earnings because you're taking all this money and putting it back into growing sales and marketing and new markets and R&D to create new products. So that's all dedicated to growing revenue. If you are not growing, and by that I mean call it 30% or north, if you're growing less than that, you need to be producing economic profits. And that's when an EBITDA multiple will come into play. So there's this thing, it's a little People magazine-y, and it hurts me to quote it, but frankly it's true, and it's empirically true. The rule of 40, which is your revenue growth percentage and your EBITDA margin should add up to 40. So you can grow 30%, but you should have 10% margins. It's give or take. And that is the measure of your business. So you can grow 40% and be break even. And then the other key piece that we're more and more having conversations with business owners is unit economics, which in tech for the last 10 years is just enough. Nobody wants to talk about that. But if you sell this, there is a piece of it that is cost of goods sold, and there's a piece of it that's operating expenses, and there's a piece that's profit. And you need to know each time you sell this so if you're negative, that's okay, unless you remove that sales and marketing and you're still negative because you're not going to pick it up on volume. You're just always going to lose money. So that's a bad business model. So we're having a lot more conversations with tech companies around keep growing, but understand your unit economics. Understand that, yes, I can remove 4 salespeople, if coronavirus hits and it's terrible and it really slows things down, I can course correct and produce economic profits to survive. Whereas maybe my competition has been growing at all costs and not minding the store and is super bloated, and their answer to, oh, we're losing money, is to just bring in more VC money, right? And that's been very easy, and that's what's happened for the last 10 years. The people who know their business and their business model, that's a more valuable business, and that gets back to what we work with people like Jackie on that model is what does it look like projections-wise, and what does it look like in the past, and let's get really smart so we can push back on every single buyer who pushes. They're all trying to find soft spots because they don't want to pay top dollar. And if the best defense is a super strong offense, and if you have already anticipated all those pushbacks, you're in the driver's seat and you can command what you sell your company for.
Great. So you've engaged a banker on a contingency fee. For those of you that are not familiar with it, that's how bankers work. You've engaged Jackie not on a contingency fee because they don't work on those.
No, we get paid whether it closes or not.
And you're ready to go to market. Eric Martin, you're familiar with cap tables and problems on the back end. Tell us about some of the legal or investor relations or record-keeping, sort of nightmares, and just what can companies do up front to make sure that they don't, have those problems?
So, in our role as shareholder rep and paying agent, our core function is really at closing, or really the 30 days or so leading up to the closing of a deal, and then forever after that. One of the things that we see a lot is that companies who have grown quickly, who have been focused on their product and their service and their market and their customers, all of which is totally right, which is why they're being sold today. But they've kind of neglected a lot of times their own store. And so the cap table, the shareholder list, contact information, email addresses, even updated rounds of financing with diluted values of the common gets this percentage, and the Series A preferred and the Series B preferred. It can get pretty complicated, and I will tell you that it is a fire drill more times than not when we get close to closing to get all that put in order. And I will also tell you that nothing matters more to anyone that's listed as a shareholder on that cap table than getting their wire on the day of closing. And nothing stands in the way of that more than anything than a disorganized process around communicating with shareholders, getting the numbers correct, And I will say one last thing, there's nothing also worse than sending out the wrong amounts of money to the people, because getting the money back is impossible. And so locking that down and having it perfect to the penny, but doing it in a calm, collected, organized way as you lead up to the closing, it's good advice.
Yeah, I think whether you're entering into a proprietary transaction, I think there's a little bit of a misnomer. I think a lot of people think, if I'm going to do a non-proprietary full-based auction, I really got to have my house in order because I'm going to have 50 people in there sniffing around. The reality of the situation is once you're in a proprietary transaction, you're usually under exclusivity, and the buyer starts asking for everything under the sun and going way deep in their diligence. So in either case, you really need to have your records in order. Chris, any thoughts on sort of legal topics that are, background to make sure you're sell-side ready, and so you don't experience a surprise down the line?
Yeah, absolutely. I mean, kind of echoing Eric's sentiments there, understanding your cap table and really having an understanding from just a background corporate organizational perspective of how your business is set up and who owns it is absolutely paramount. It's going to serve as the basis for, to Eric's point, who's getting the money and how much are they getting. And so having that tied at the outset is really mission critical to be able to go into the process well prepared. As well, I mean, particularly with a tech lien, understanding chain of title with respect to intellectual property is critical as well. Oftentimes, you've got a group of people in a garage that have started a business and they didn't have money for legal fees at the outset. And sure, they may think that the company owns the intellectual property that's material to the business and what your buyer is really hoping to acquire in the transaction, but that's not always documented the correct way. It's a relatively simple process to go through and figure out exactly what documentation is there, and if corrections need to be made on the front end, they can be made on the front end. It's a much more difficult conversation if you have to have a buyer come tell you it's not been done right. So cleaning those two things up in particular is going to serve you well in any sales process.
Okay, so records are in order. Adam says your business is worth 25 times revenue. Let's go get it. How do you go get it? How do you have a conversation, and how do you steer sellers to the right way to sell their company? Should I engage in a proprietary deal with my main customer and call it a day? Should I enter into a limited auction to at least scare my main customer so they buy me? Maybe should I enter into a broad-based auction process with 40 bidders over the course of the next 6 months? Adam, what sort of guideposts do you use to help set up the right way to sell a company?
So I think just good practice, whether it's a 10-person auction or a 310-person auction, is preparation. And so just to feed on what Chris was talking about and what Eric was talking about, getting everything in order, benefits plans, know the assignability of contracts, anticipate everything. And so we do all of that before we take a company to market, whereas in the past, and I don't want to get too deep in the weeds, we used to go into the market, we do some diligence, a fair amount, and then we get exclusive, and we would be 60 days of exclusivity, which means we are only working with a single party. And to your point, Mark, it's when you've lost all your leverage, and they're saying, well, this is wrong, and how about this, and did you think that, and you're reacting, right? You're on your heels. Whereas if you do that at the beginning, before we pick up the phone to call people, it makes for a much smoother diligence process. And so we've been pretty successful taking that 60 days at the extreme to 10 days, but often, 2 or 3 weeks, maybe 30 days, because we're so tight and so clean, and this company is ready to be bought. The other neat part about that is it conveys a message alongside having a sell-side QOV that we are prepared to be sold, and we are professionally run, and our books have been scoured by experts like Jackie, and by legal experts like Mark and Chris. And so doing all that work up front is crucial. So back to the do you go broad or not? It's really, I see very little reason now. I'm paid to get the highest price for my clients. I see little reason to go after 5 or 10 or even 30 or 40 people. Unless confidentiality is just really, really important, beyond important to you, and you don't want that out in the marketplace, and you don't want your employees to know about it, and you're concerned about it in certain sales situations, that sort of thing, I see little reason not to go after 250 parties on almost every business that we bring. It is a sales funnel, and it's just like if you wanted to sell this and you went to this many people versus this many people. We have charts where we have sat down with clients and they've said, oh, these 4 people are going to be the buyers for my business, maybe this guy. And then we have initial indications of interest that come in. And so we have, this bid distribution of these 40 people that said, here's what we think your business is worth. And those 4 at the very beginning are way over on the left side. And that's why you run a process, it's price discovery. Because you are going to find somebody in there that maybe your client wasn't quite sure would stretch. And maybe collectively, you and your advisors didn't know that this private equity person had a thesis in GovTech, for example, and really was going to stretch for this company to be his or her platform. If you didn't call that person, you're not going to sell for that price. So we see little, now we will listen to our clients, and we have absolutely run 30 type people auctions, go after just strategics. And maybe you stagger it. We're not huge fans of that either. What we tell people is the entrepreneur 99.9% of the time knows when the time is right to sell their business. It's intuitive. We have empirical data from the past where somebody thinks it's time and maybe even runs a process and just gets a weird feel, the business owner, and says it's not the right time, and then runs it and then sells it for sometimes 20, 30, 40% more. We have these cases, and you will know better than the bankers for sure, better than the market for sure. You've been in this industry, you've lived this business, you've thrown your blood, sweat, and tears into this business, and you know what the trends are, and you will know when the time is right. And then we'll tell you what it should be worth, and we will package it up and go after as many people as we can, and hopefully get it done for the highest price possible.
So a critical step in the early part of the process here is something that we've mentioned, and a lot of you may not know the word. It's diligence. And what does that mean? Diligence is a fancy word of essentially a buyer or a set of buyers reviewing the seller's information, whether that's financial, legal, industry-wide, HR. They will look under every possible rock that you allow them to look under. They'll do it under a non-disclosure, confidentiality agreement. And I think for this sort of topic, I think one of the things you need to know that this is a huge effort on both sides of the table. This is probably the most expensive portion of any transaction, is number one, for a seller to prepare the diligence, because they've got to do it. We'll talk about how and where they do it. But also for buyers to actually engage advisors to help them with this, because these are thousands of documents in almost every single case of any material transaction. But so I wanted to ask Eric Lintel. First, Eric, will you give us sort of a little description of where you guys are in the process of your transaction? And then I assume that you underwent a huge sell-side diligence effort, kind of lessons learned in that, how you went about it, and some suggestions for the group.
Yeah, so we signed a deal with Google to be acquired by Google on October 31st. So we're in the middle of regulatory review process. We've let the markets know it's probably sometime in 2020, but it's a pretty challenging regulatory landscape these days. So it's not deals that used to take 3 or 6 months are taking 12 to 15 months because of the level of review from both the U.S. and the EU perspective. So it's a long tail in between these days. The diligence process is a very painful one, especially when you're on the sell side. I think it ruined a better part of my last year. So I think, trying to do as much of it up front before you get into an exclusivity scenario is great, because once you're exclusive, you are a little bit contained, and they can keep asking and asking and asking. I think that's why it's really critical to have an end to that exclusivity and drive them to that, because you can just say, look, guys, at some point you've got to make a decision before exclusivity runs out. But I think, right, on the public company side, it's usually a little bit easier because you're already have financial reporting that you do on a regular basis. They have some comfort level with what you've been reporting over the last year, 2 years, 3 years, however long you've been public. So it's a little bit easier, but it's still a very painful process. I would wake up, when we were in full diligence mode, I would wake up to 100 to 200 fresh requests every morning at 7 a.m. and we'd have calls from 7 to 10 a.m. And then you'd work until 2, 3 in the morning when you're trying to get those 100 as far along as you can, because you know you're going to wake up at 7 a.m. the next day to another 100 or 200 requests. And that will go on forever until you sign the deal. And so at some point, you just have to sign the deal, move on.
So you
the
can
great
blame
thing about once you sign is they're not allowed to do diligence anymore.
That's right. So you can blame Jackie and Chris for those questions that they probably people like them lob over to you during the middle of transactions. Chris Wygand, what could you give comments on sort of the blocking and tackling of diligence? Like, how does it work, and how do you convey all this information? Are there tricks to the trade that could help sellers in the market?
Yeah, absolutely. I mean, as everyone's mentioned, it's a burdensome process. From a sell-side perspective, I mean, again, doing as much as you can on the front end serves you well. But in terms of actual blocking and tackling, so mechanically what you're going to be doing is pulling together all of these agreements, documents, informational requests, responses, and you're going to be putting them in effectively what is an electronic data room. An electronic data room is just a third-party advisor usually that will facilitate uploading all of those documents into an electronic platform that can be accessible by those of the buyers that you're willing to give it access to. You will then have buyers coming through, reviewing all of that information, and they will start to send you request after request after request for more information or clarifying information. A great thing to do on the front end before you get too far down that process, especially if you're working with a small number of buyers, is just get on the phone. Get on the phone and have an introductory call that explains for everyone kind of the general nuts and bolts of your business. What do your commercial contracts look like? What do your employee benefits plans look like? Just have that initial discussion, and that'll go miles, particularly for your legal diligence teams, on helping piece together your business, because a legal diligence provider may be looking at your business for the very first time. They may not do a ton of work in your industry, and they need to piece it together from a legal perspective and figure out what those risks look like. So having that phone call on the front end can really go a long way to alleviating the burden of requests that to you as a business owner and operator may seem incredibly simple, but to a legal diligence provider who hasn't worked in the industry may not have that same level of expertise.
Yeah, I mean, I'd add on just a touch to that. So the EU market works differently than the US market in this respect, in that the seller is kind of tasked with doing the diligence and then disclosing it all. We put the burden on the buyer here, so you can end up with multiple parties in a broad-based auction sort of doing the same exercise. So one thing that sophisticated sellers with good representation are doing is sort of preloading it. They're preloading the diligence. So they're getting consultant reports in the industry. They're putting those out there sort of for everybody to universally use. They're getting sell-side quality of earnings reports from somebody like Jackie. They're getting tax NOL studies done. They're getting, in some cases, full-blown change of control analysis on legal contracts. Just basically giving the buyers shortcuts to complete the diligence, which I think can be a good use of time and money. It is expensive on the sell side, but it can also save you from 20 different parties asking you 100 questions at a time. Okay, so moving on just a touch to facilitating and surviving diligence. Real quick question, I guess, for anybody on the panel: has anybody seen technology tools that have really, really advanced the game here, that have shortened or automated processes within diligence, the diligence aspect of a transaction? I'll just open up for anybody to really comment what they've seen as being successful. I mean, I'll comment on like what everybody thinks is going to happen, and that is that sort of AI is going to take over, and there's products like Kira. I see Scott Smith back there. That their AI tools that are embedded in data rooms will eventually read the documents, and then it will just spit out the results. I haven't seen those as successful, but I think that's the trend. Has anybody seen, progress?
Yeah, I mean, so, right, when we were in the midst of diligence, some of the things they want to see are, do you have any agreements across your company where you've limited how you can do business? Like, is that going to infect us once we buy it, right? Have you said you won't compete in this area, and it includes all of your affiliates? So when we buy you, it's going to include us as well. So you're trying to get across your landscape very quickly. We had 25,000 plus contracts, and for us to go try and look at 25,000 plus contracts and make sure that there's no clauses in those to do that, really difficult. Luckily for us, we already had a contract repository that allowed us to do that type of dynamic searching across it. So I think I think it's still in its early days, but you are being able to do things that you wouldn't have been able to do 10 years ago, where you would have had to throw bodies at 10 years ago, where You can keep much smaller diligence team. But I think for the size transaction we had on our side, we had five people working on our diligence team in-house, right?
Well, that's small.
We had two people on the legal team, one or two people in finance, right? So because of the sensitivity of the transaction, you're trying to keep the deal team really small, and so you're trying to use tools as much as you can to be able to do kind of the grunt work.
Yeah, I would echo that absolutely. The tools are the key, and to mention the AI point of view, I mean, this is an area, it may not be perfect right now, but in 5 years, it's going to be revolutionary. I mean, even in the last 2 or 3, I mean, so this is an area where law firms in particular are constantly pressured to be thinking about new and innovative ways to kind of stem off the cost of diligence that Mark mentioned. AI is going to be an answer for that to some degree, and it is right now an answer to some degree. Kiro's an example of one of the platforms out there that you can just upload countless amounts of contracts and it will spit back search results for the exact types of provisions that Eric was just talking about. Again, it's not a perfect science yet. We're still kind of working through the kinks and making it kind of better each and every time, but it also, because it's AI, it learns. And so it's going to happen quickly, and it's going to be something that's very real and very transformative, particularly for the legal profession.
Yeah. I have one other tip, which maybe it's because I'm a retired accountant, that I suggest to any sellers in diligence, and that is that the most important person on your team is usually your CFO. I just think that they know better than the legal team, than the operational team in many cases where the bodies are buried. And having a strong CFO that knows the inside and out of their quality of earnings reports, but at the same time knows the inside and out of the guts of the business is really helpful. And if you don't have one, and you're going into especially an auction process, you maybe need to think about an outside advisor who could be a hired gun to serve that role, and getting that person in the door at least several months in advance. Okay, so Eric Lintel mentioned something that's really interesting. So you're in the middle of a deal, you're trying to figure out how many people you're going to go out to. There's actually, some thought process that has to go into, should we go out to people that are in our exact same industry? We have a regulatory environment, which most of you probably are aware of in the United States, that we have not only antitrust requirements under something called the Hart-Scott-Rodino Act, which has mandatory reporting and review by the FTC or DOJ, but we have other regimes in place, something known as CFIUS, which is in place anytime there is a non-U.S. buyer of the business. So it's essentially a national defense or national security regime that may need to be complied with. You mentioned it, Eric, so we'll tee you up first. What would you say about the state, particularly of the technology market for antitrust review in the United States?
I would just say most tech companies have it in the back of their mind, right? That deals are getting harder to do, they're taking longer to get done, so they're thinking about them differently. It's causing them to start to analyze it a bit differently.
And many of you may know there's also some recently announced activities by the FTC. Chris Wygand, do you want to go ahead and maybe talk about what the FTC has done earlier this month?
Yeah, absolutely. So you may have seen headlines on this, but the FTC has the ability to effectively go back and review non-reportable transactions. And they recently pronounced that they're going to do just that, and they're going to do it with the 5 biggest tech companies in the world. So you've got Apple, Google, Microsoft, Amazon, and Facebook, who are all going to have effectively the last 10 years of their non-reportable transactions reviewed in detail by the FTC and DOJ. And this is what they call kind of an educational study. It's not an enforcement action, but instead they're looking to determine whether or not the HSR and kind of antitrust regulatory environment is doing what they hope that it should be doing, particularly in the tech space. And part of this study is it's going to obviously be a diligence exercise of an almost unlimited volume of information. So it's going to take a while. It's going to take time. It's going to take a long time for these companies to gather the information that the FTC is looking for. And then it's going to take a long time for the FTC to review that information. So it's a very interesting thing that's happening right now, but its effects and kind of the net result of this study are probably, from what we're hearing, a couple years down the road.
And I think if you think diligence is painful, the government review of the deal is about 10x amount of pain.
When you say non-reportable transaction, I guess what's the current threshold?
Yeah, that's a great question. So under the HSR Act, generally speaking, if you have a transaction that's valued at $94 million or greater, you're subject to the mandatory filing requirements, and that's what's called a reportable transaction. So a non-reportable transaction would generally be a transaction that fell below that threshold. Those thresholds change every single year. The FTC goes in and updates those threshold amounts. So we're basically talking about smaller tech transactions and understanding whether those smaller tech transactions should, in the FTC's viewpoint, be subject to the same level of scrutiny that a larger tech transaction might be.
Yeah, and I think what's important to keep in mind here, number one, I think on reportable transactions, Eric Lentell said it best, heightened scrutiny is out there on reportable transactions. You're going to have longer to get through U.S. Antitrust review in the technology space. I actually would say that's a broader topic. So people used to file for what's called early termination. They still do. Has positives and negatives. But one of the positives, it could happen faster. And really under the current administration, it hasn't been happening really any faster. And so most people are foregoing early termination because the whole period was running anyways before they got their response. So I just think there's heightened scrutiny. I think the other thing that really is important to keep in mind is why are they doing this? And their stated goal of reviewing these, literally it's going to be thousands of transactions for sure, is to see if there have been nascent technologies that have been acquired by large tech companies in order to avoid potential competition down the line, to essentially acquire instead of compete with nascent technology companies. That's their stated goal. We'll see where it comes out.
I think one of the other things we mentioned, Mark, too, in that framework is that traditionally data and privacy have not been considerations in the competitive review, and that's changing currently. I think the Department of Justice and FTC are trying to change their views on that. So is the European Commission. So I think last week, one of the oversight body for the European privacy regime basically said that we think companies should be doing a privacy impact assessment prior to even notifying the European Commission of a potential merger. Whereas I think most companies view that as something that happens after closing. So I think it's really an evolving space, and companies are unsure of how to be approaching the space right now.
So if your company as a seller has non-U.S. operations, do you want to comment? I mean, I think that anecdotally, everybody would say that the process, particularly in the EU, and now there's going to be a separate UK process, used to be together, is meaningfully more painful than the United States. It's exponentially more expensive than the United States, and that's just antitrust, right?
I think it depends. It's funny that when we met with them, their view is actually the opposite, that they have a better regime because ours is actually a duopoly where theirs is a monopoly over the review process. So I think they actually seem to be much more thoughtful on the process, but they're doing deeper reviews.
Okay. Just one more topic on non-U.S. operations. Chris Wygand, do you want to talk about foreign direct investment just real quickly on CFIUS and then all the corollary regimes around the world?
Yeah, absolutely. So CFIUS is the Committee on Foreign Investment in the United States. It's effectively a national security regime. It's an interagency committee. It's basically 9 agencies in the U.S. government that are reviewing foreign investment into the United States. Foreign investment into the United States, whether that's from private buyers or even more sensitive in some cases, foreign governments taking ownership interest in U.S. businesses. Recently, CFIUS came out with final regulations implementing what are now mandatory filing requirements with CFIUS. Traditionally, it was a voluntary filing regime. Now, if you have a foreign government that is acquiring a U.S. business under certain circumstances, or if you have a just foreign person acquiring a U.S. business and that U.S. business operates in particularly sensitive areas such as technology, infrastructure, and data, as Eric mentioned, you're actually subject to a mandatory filing now with CFIUS. And whereas on the antitrust review, in a low-risk transaction, you could be looking at as short as 30 or even 18 days to get approval, CFIUS is a much longer process. It can be 3, even 6 months to get approval without going into kind of secondary requests and additional information. So it's absolutely top of mind, I think, for all sellers right now when you're looking at a buyer pool. And to Mark's point, this exact regime exists in almost every other foreign jurisdiction in one form or another. And so again, if you have subsidiaries with foreign operations and you're selling your business, you need to be thinking about whether these approvals and filings are required in those jurisdictions as well.
And there's not an EU equivalent of the singular filing system. So if you have a company that has substantial EU operations, you could be looking at 15 different foreign direct investment regime filings. Extraordinarily burdensome. So think about that. If you have non-US buyers in a transaction, you need to be thinking about CFIUS. If you have non-US operations in either your company that you're selling or the company that you're buying, you need to be thinking about foreign direct investment regimes throughout the world. So life's getting more challenging. Okay, so those are some considerations of who we're even going to consider. Let's say we've run a process. We've gotten bids, multiple bids. You've done a great job, Adam. We have 4 competing bids. They all arrive on the same day. You've gone into your funnel and you've got private equity buyers. You've got strategics. You got a mix. What are you looking at in terms of how to advise a seller on selecting a buyer? Is it just the number?
No. So thankfully, through the process, a couple of things. There will be a socialization period. So we'll get bids, and then we'll have a management presentation where the management team and the owner will sit with parties and further describe the business and talk about the growth and things that maybe weren't in the initial materials that were sent out. And it's a getting to know you kind of a process. Also, through all of that diligence period, once you get to that final bid, you'll know, because people have been having phone calls with us and with the attorneys and really with the management team, you'll know the level of interest. And some people can bid high but not do a lot of work, and so that's a suspicious bid. But then it really comes down to personal preference. What is your legacy? What did you envision when you started this business? We have had VC-backed businesses, in fact, one that was on the screen earlier, where the VCs allowed the management team to take a lesser number because they felt that this buyer, it was Goldman Sachs, was really going to be a wonderful place for their employees. It was a wonderful culture. It was a fintech deal. They were really excited about that. And so they literally left some money on the table. We did a deal 3 or 4 years back in the prop tech space where these owners, our clients, refused to sell to the Death Star in their industry. They could not live with themselves if they had just made all this money, enriched themselves, and sent all of their employees that they had built this business with to go work with this Death Star. And so they took a private equity deal. So it's really your personal preference. And then the other thing I would say is that private equity has changed a lot, dramatically, over the last 5 to 10 years. It isn't all about financial leverage, and they're not terrible people. They see thousands of business models a year. And so they do have some pretty interesting views on successful businesses. And maybe, remember this company that we saw and how they incented their salespeople. And so they're really providing some pretty interesting value. In either a strategic or a financial buyer, there is change, and change can be painful. So one is not necessarily better than the other. Things will change 100%. You've built this beautiful business and you think whoever owns it is just going to continue. They're going to change it. They own it. They paid you tens or hundreds of millions of dollars. It's their prerogative to do what they want. And hopefully, if it's private equity and you've rolled some of your equity alongside these guys going forward, hopefully the change is for the better. It will be uncomfortable, right? Maybe there's this, for lack of a better term, sacred cow, this person that everybody liked, that was part of your team, but that they're not quite carrying their weight in the new owner's eyes, and maybe that person is no longer an employee after a year or two, and that's difficult. And it's difficult to still be a part of that organization and see the new owners make those changes. But they're put on this earth to make money. So they're not making changes just to make changes, because they have limited partners and they need to produce returns. So they're making these changes for a reason. So it's all over the map. It's really personal preference. But I would say it's leave the, what you feel this certain buyer is going to do to your business. Have a lot of conversation with your management team, with your advisors, because your preconceived notions about those particular buyers might be wrong.
Okay. Most bankers just say certainty to close when you ask them that question because they work on contingency. That's just a joke, but that's true. I actually...
That's important too.
Yeah, so I think it's probably worth, maybe Chris Weigand, could you say, like, when you get free bids and you're lining them up, what are the things that you're really focused on? And, it's not just the top line number, but, can we actually stick that number in our pocket, I think?
Yeah, absolutely. I mean, so obviously price is the first thing everyone's looking at, and so we want to see how much money we're getting paid. But after that, you want to see how quickly you're going to get paid it, and what's the certainty surrounding actually receiving that money. A couple of ways that could play out is conditionality around closing. Are there things that could upset the ability for this transaction to actually close? Another one is just general sophistication of the buyers that you're looking at in terms of executing deals. It's not necessarily the case anymore, but private equity is in the business of buying and selling businesses. They're good at this. They're good at doing it very, very quickly, and they engage advisors that know exactly how to kind of work within their parameters to get a deal done. Now, strategics are becoming more and more adept at this, and they have amazingly built out in-house legal teams that have deep M&A experience, and so they may also have the same ability to execute. But as a general matter, private equity really is focused on getting that done. And then the last thing we're looking at, and it really goes back to kind of Adam's point on having a discussion of what does the founder want for the destiny of their company? Are they looking to exit the transaction and not be involved in the company going forward anymore? Do they want to get some liquidity now and have opportunity for greater upside in a couple of years? I mean, if you're looking to exit now, strategic might be a good opportunity for you. If you want the ability to get some liquidity today and have additional upside down the road, Adam mentioned a rollover, which is taking some of the stock that you have in your business and continuing that investment through your private equity owner on a go-forward basis. So that might be a better avenue for you if you're trying to stay involved and see some more upside on the back end.
Yeah, Eric Lintel, I mean, you guys buy businesses, in which case you're a strategic. You're competing with private equity funds to acquire those. What's your sales pitch? Why do they choose strategics in your mind? What's sort of the rationale?
Yeah, I mean, we probably bought 5-10 companies while I was at Fitbit, 25 when I was at Verifone, and a lot more when I was at Dish. And I don't think there's very few of those where we're up against a private equity fund. So typically you're going to be up against a strategic, because a lot of the stuff we're doing is not looking to bolt on additional revenue, where private equity is typically more of a player and looking at deals where there's revenue generation. We're looking at key assets that may not be generating revenue for the seller or key strategic talent. And so most of the deals we've been doing over the past 5 years are key technology assets or key people assets. And typically those are different beasts because the financials don't matter as much. And it's a much more emotional process.
I think the thing that always makes me the most nervous, particularly if you're in a transaction that has private equity, for those of you that haven't lived through it, but essentially they form a shell entity every single time they buy a business, and that's who you get to contract with. So, like, how are you actually going to get paid if they decide they don't want to do it or they can't raise the money? So there's this concept of financing risk, and then they borrow 60% of the purchase price or something like that, and they do it between signing and closing. So there's this whole concept of financing risk, and I think the market's really switched in financing risk in private equity. And strategics have the money, so there's always like a preference that they're just going to write the check. And but will private equity write the check? Chris Weigand, could you maybe give us the state of affairs 5 years ago and real quickly contrast that to where we are today on financing risk?
Yeah, absolutely. I mean, so 5 years ago in a private equity transaction, a common transaction would look like you'd have a signing of a transaction and you'd have a period between the signing and the actual closing of the transaction where the private equity sponsor was arranging for financing for that transaction. And you'd have a suite of negotiated provisions in your transaction document that dealt with how you were going to help them go get that financing, the time period they had to arrange for that financing, and then most importantly, what would happen if they didn't get that financing. And a common path 5 years ago was what's called a reverse termination fee, where the agreement would terminate, the deal would die, and you would be paid a percentage of the deal's value as kind of recompense for the fact that the deal didn't get done. That was 5 years ago, right around 5% or something like that of deal value was a common peg. Nowadays, though, and part of this is all about the dry powder Adam was talking about at the beginning of our discussion today, we're seeing a trend to private equity sponsors being able to just say, we're going to commit to you at the signing of this transaction that we're going to write a full equity check. And what that means is we're going to tell our fund that it's going to backstop our obligation to get this deal done. There's not going to be any financing risk. And if it comes to it, if we don't think we can arrange for financing, we will have to call capital on our limited partners, and we will have to ask each of them to fund whatever the size of the equity check is to get this deal done. And part of the reason they're willing to do that is the debt markets now are as favorable as they've ever been. Interest rates are incredible, and so they have preferred lending relationships that they can rely on to get these deals done very quickly. But it's definitely a shift that we're seeing from the old model.
Almost every sophisticated fund, essentially has also its own borrowing capacity, so they may not have to call capital immediately. They can actually borrow on a fund borrowing basis, and then go refinance the transaction and only call the equity. So really a dynamic shift in the market there. Talking about some other topics that are kind of within deal execution, there's a couple other financial pieces other than just the purchase price in transactions. As a lawyer's standpoint, they always cause me a little bit of consternation. And that is sort of like, if you've got an earnout, why does it exist, and what can we do to make sure it's clearly drafted? And earnouts are less common, but working capital is pervasive. Jackie, could you tell us sort of what you guys do to sort of help to support, in particular, working capital analysis, how people think about working capital from a conceptual, and what can people involved in transactions, including lawyers and other advisors, do to kind of narrow the ripeness for disputes in those?
Mm-hmm. So along with the agreed purchase price of a business, the assumption is that the business is going to come with a normalized working capital, which should be defined in the purchase agreement. And so again, you have this word normalized, and you have to define what that means. So similar to on the earnings side, you're pulling out anything that's unusual in the historical basis. When you look at your working capital, you have to determine what normal means. You're going to pull out unusual receivables. You're going to pull out unusual liabilities to say this is representative of what normal working capital looks like. And between the time that it's been agreed upon to the time of close, you're going to expect that amount of working capital in the business. So your current assets and your current liabilities as it's defined. What happens is that sometimes the business has been ignored. Maybe receivables have increased in time, or something has been let go with liabilities, so that working capital is no longer at this normal level that would have been expected. And so that difference in working capital will be a direct change to your purchase price, which is why it's such a contested amount, and why it's so important that when you are determining what your normal working capital is, that you're using concrete, repeatable data that can be defended with lawyers.
Mm-hmm. Eric Martin, as a shareholder rep, I mean, it's anecdotally been told to me that the vast number of disputes in M&A transactions are about working capital. And if there is an earnout, that is actually the most disputed topic as to whether or not you've actually met the earnout or not. Can you give us any thoughts in the hundreds of deals you guys serve as the stockholder rep, just how often there is disputes?
Sure, and I'll set the stage by kind of talking about how often we see both in the contract in the first place. So in our private target transactions that we work on, and we see 200 to 300 a year, and we've been a shareholder rep about 2,500 times now, so that's kind of our data set. We see working capital adjustment provisions 70 to 80% of the time. Most agreements have the provision built in that just says we're going to estimate the working capital number at the time of the signing, and then at the time of the closing, the buyer then has 30 or 60 or 90 days to true it up. and effectively kind of balance the checkbook, reconcile against actual activity during that period of time and see what the difference is. So we've got a team that really all they do all year long is working capital adjustments. And happily, alley fights in working capital are pretty rare, right? But there are disagreements. And what we find actually more often than anything is broken language. So we see, we read provision after provision after provision of working capital and how the definitions tie together. And we actually find a lot of documents that just have a break in the way that the defined terms work. And so it's a little bit of reverse engineering to go back and ask the parties, what did you mean? What did you mean by that? On the earnout side, so Mark's comment is totally right. Whenever there's a deal with an earnout, and by the way, earnout is simply a term that means you get $100 million at closing, but if something really great happens after closing, you might get another $100 million or another $500 million or something like that. Two main pockets of earnouts. You've got financial targets that you might reach. Right? Maybe it's revenue, maybe it's an EBITDA-based something, maybe it's something totally different like unit sales or product delivery. And then on the other side, it's more regulatory kinds of things. We find this in healthcare deals or biopharma deals where it's FDA approval and then it's human trials and first doses and those kinds of things. In the first category, the financial kinds of earnouts, we see earnouts in that universe of deals about 10 to 15% of the time historically. So not very often. Kind of heavy contrast in the biopharma space, we see earnouts in about 75% of deals. And the reason is, when the biopharma they're cooking up a new compound or a drug or something, and the big pharma comes in and buys it, it's a bit of a gamble. It's a little bit more of a venture capital purchase from their standpoint, which is we think this drug's going to work. So we're paying you $100 million today for it, and if it really does, then we'll pay you another $500 over some milestones over time. Language to describe what a buyer's going to do to actually realize those good faith efforts, best efforts, commercially reasonable efforts. These are all kind of pretty vague terms that you can fight about in an alley a lot. And so we actually recommend large set-asides of a cash emergency fund after closing to deal with arguments around earnouts. And earnouts really are, especially those bigger ones, a source of great long hours.
And the consternation here is that the seller is trying to hold the buyer accountable for operating the business so that the earnout can potentially be achieved in whatever fashion the seller thinks is the right way. And the buyer's like, I bought this business. I'll run it however I want to, and if I make extra money, I'll pay you. And sort of holding each other accountable to those standards in the drafting of the language is a big challenge in these transactions. I'm going to hit real quickly something that I actually think everybody in this room, especially if you're involved in M&A transactions in the long term, there's always this concept of market. So what is market in the M&A context for X or term or Y term? And it's not a great negotiating tactic for you law students, but it is out there because there's so many data points about what people are doing in M&A transactions from various terms, and it particularly post-closing risk, which we'll talk about in a second. But there is a lot of deal studies out there that study what is market, what does financing risk look like for market. The big flaw in most of those deal studies is that historically they've relied and only had access to public company documents. But in order for there to be a public company document, it means that the party involved, either the seller or the buyer, was public to start with, which is a fractional amount of companies in the world and a fractional amount of M&A deals. And more importantly, where you have a very large public company buyer that's buying a small company, it's not a material enough agreement to have to be filed with the SEC. Suffice to say, the data set behind public company targets need to be used just for what they are. They're public company targets. You shouldn't apply those principles to private company targets. So how would anybody get a data set of private company targets? Eric Martin could tell you.
It's a great commercial. Thanks for that. Our company is a lawyer-founded company. Our founder and CEO, his name is Paul Koenig. He was a Cooley lawyer, and before that he was a Latham lawyer in Chicago. And when he first started SRS Acquium in 2007, 2008, one of the things that he was aware of and conscious of and wanting to do for kind of his peers was to deliver back to M&A practitioners what's market. And so really from the very beginnings of the company, he started putting together a deal term study that does exactly what Mark just talked about. We have a list of, I think it's a couple of hundred data points that we, as the shareholder rep, because we're the party to the merger agreement, we actually have a copy of the contract, so we don't have to mine Edgar or some other database to find it. We just have it because we've signed it. And so we have a process behind the scenes where lawyers pull out and extract, on a very regimented basis, data points that we put into our database and then republish it for free out to everybody. So you can go to our website and download the whole thing for free and take a look at it. And just to kind of punctuate the universe quickly, about 35 to 40% of our transactions are public strategic buyers. The rest of them are not. So they're either a strategic buyer, a la a portfolio company of a private equity fund or some other private strategic, a true financial buyer, a true private equity fund who's the buyer, or a foreign buyer. So there's a data set for foreign buyers as well. And our online tool lets you filter on all those things to be able to narrow your universe a little bit. So that's how our data study comes together.
Okay. So I think we're to the point of, we've got a deal, we've got a buyer, we've selected the horse we're going to ride, we've got our financing risk nailed down because they've signed, if it's a private equity buyer, they've signed a full fund guarantee. This deal is definitely going to get done. What is the most negotiated part of the deal at that point? It's actually the post-closing risk that's associated with the deal. So how much is the seller putting at risk after the closing that he or she or it may need to pay back to the buyer of the purchase price because of various things, principally breaches of reps and warranties, because they said, these are our financials. Well, it turns out they're a little wrong, so they overpaid. There's all kinds of reps and warranties. So post-closing seller risk is by far, I'd say, the most negotiated part of most M&A contracts. Maybe, Chris Wygand, you could give a little state of affairs of sort of what a traditional package for a private company seller is. And what's called indemnification. That's the fancy word used in M&A jargon.
Yeah, absolutely. So Mark's exactly right. These are heavily negotiated provisions, and you'll bang your head against a wall reading it in your purchase agreements, trying to figure out exactly what they mean and trying to figure out why the buyer is getting all of these special indemnity rights. Well, the reality is, on its face, yes, it may look like this is a very buyer-favorable construct, but in all actuality, it's seller-favorable, and we'll explain why in just a minute. But what a traditional indemnification section of an agreement looks like is an agreement from the sellers to indemnify the buyer or make the buyer whole for losses associated with things like breach of rep or warranty, breach of covenant in the agreement, and then perhaps other specifically negotiated items such as taxes or findings and diligence that the buyer is concerned about risk on the back end. There would be a negotiated period during which those reps and warranties, for example, would survive on a post-closing basis. Commonly 12 to 18 months would be a middle-of-the-road position to agree to for how long you would remain on the hook for a breach of a rep or a warranty. And then there would be a suite of negotiated limitations. And this is where the seller favorability comes in, because instead of allowing a buyer to have a common breach of contract claim, which could be unlimited in amount and a court could prescribe punitive damages for the claim, you are going to negotiate with your buyer that the sole and exclusive remedy under your transaction document are these negotiated indemnification provisions with these limitations. And the limitations often will take the form of, for example, a deductible. So we all have insurance policies, we all have car insurance, you pay a deductible, same exact concept here, except you're talking about the losses associated with a breach of rep warranty. And you'll also have negotiated caps. You'll have negotiated escrows. So you may agree that you'll put some of your transaction proceeds into escrow in case a claim arises on a post-closing basis. All of these limitations are curtailing the buyer's ability to come after you for unlimited periods of your proceeds.
So market in this traditional sense, we're going to contrast what he's talking about here in a second to kind of shifts in the market that have happened. Traditionally, it was like 1% or 0.5%, just to give you magnitude of what the deductible was. So for the first 1% of the transaction value, the buyer just ate it. Like they couldn't come after the seller. And then there were caps on that. So for breach of rep, you could talk about 15 to 25% and negotiate it. If the damages associated with whatever happened were above that 15 or 25%, no recourse against the seller. So the seller was basically saying, I'll put 1% to 15 to 25, whatever that number negotiated be, at risk for indemnification, and I may stick that in an escrow, third-party escrow, so that if the claims happen, the buyer knows the money's actually there. So that's sort of the traditional model of indemnification. Maybe, Chris, it's worth contrasting some of the different flavors that post-closing seller risk looks like in the competitive market. now.
Yeah, absolutely. I mean, the good news here is negotiations are shortening dramatically. So we have, in the competitive frothy environment that we have buyers that are willing to, in a lot of cases, for example, undertake what's called a no survival or public company style transaction where there is no post-closing risk. They're willing to step up to the plate and say, we want this business. We think it's perfect for what we want to do, and we're so confident in that, we're confident in how it's been run, that we're not going to ask you sellers to take any risk whatsoever on a post-closing basis. That's becoming more and more common, particularly in a competitive auction environment where you have multiple bidders competing against each other. Another very, very common model that we're seeing now, and it's another form of insurance, it's called Repin warranty insurance. These policies have been around for a while, but have really just come into vogue recently. And this is an opportunity for buyers or sellers to purchase an insurance policy against future breaches of reps and warranties under their transaction document. It's a negotiation as to who actually pays for the policy, but it allows the buyer to have a insurance product as opposed to a group of sellers that they're going to be recovering against. This is particularly helpful in the private equity context where optically it's not great to be suing your management team. And so it's great to have an insurance product that you can stand behind as an opportunity for you to recover in those scenarios. And in the competitive environment, we're seeing buyers willing to agree that insurance policy is the sole and exclusive source of their recovery.
Yeah, a stark contrast from 5 to 10 years ago. I think it's really important to keep in mind that to drive the type of terms that Chris just walked through, which are very seller-friendly terms, i.e. I'm either walking away and no one's ever suing me for anything, or you're really not suing me, but you're suing an insurance company. In either case, the seller has pretty limited risk in those. In order to drive those, you really almost have to have a non-proprietary auction process where you've got multiple parties knowing that there's a deal dynamic that the other person might do that. And if the other person does that, then their terms will be non-competitive if they offer what the traditional model to put the seller on the hook for. And so in competitive auctions, you're seeing a high number of bids, at least in my experience, that are either non-survival or are pure rep and warranty transactions where the sellers are not at risk. But in proprietary deals, you still see the traditional model where people take a number and put the purchase price in part at risk with those limits. So one more quick plug. I would say that of those data points that Eric Martin mentioned in their survey, like half of them relate to indemnification or post-closing risk. I would sign up and get their materials and stay on top of the market. I think we're going to pause there and open this up for Q&A, and all questions are fair game. I'd say why don't we, whoever, just jump in and answer if you feel like you're the right expert for the question. So happy to take any and all questions. Couldn't hear you. First question goes to a student.
Hi. So I want to step back to what you were saying, Chris, about the FTC regulation and how they're reviewing all of their, post-close transactions. I'm curious how you all anticipate that will change innovation and whether you think that will shift, these bigger companies' minds into maybe something that looks different from acquiring a lot of these tech companies at a really early stage.
So I'll offer my own 10 cents. I think Eric would be a great vantage point here as well. But I think at the end of the day, it may change the regulatory environment, but tech is still king right now. And so I think you're going to see companies that are continually interested in pursuing the gains that Adam highlighted that tech offers. If that means there are more regulatory hurdles that they need to jump through to do that, that might be the case. But again, as I mentioned earlier, these types of reviews take multiple years and then are also the subject of legislation. And so legislation is really the end goal here if the FTC is hoping for change. And so I think we're still many, many years off meaningful change in that regard. And so I think you'll still see tech acquisitions happening as much as possible.
I think in the short term, in a competitive environment, you'll just see a shift towards smaller tech companies and private equity companies having the upper hand in those scenarios where they're both bidding the same price, and you're looking at what's my deal risk here, right? So I think you'll see a shift towards smaller tech companies maybe winning those deals that they might not have before.
There's a microphone coming right there.
So if I have a small company we're going along a nice positive curve and all that, and there's a strategic that maybe we have a relationship with, or maybe we're just aware of each other, and suddenly they approach us about an acquisition, is that a time when I would come to you to say, are there other people out there? Do I approach you with full transparency to this potential buyer, or what's the dynamic look like with that buyer when I approach you about that?
And Eric probably has a good view here, because we do see a lot of that instance where you've had a partnership, you've had a commercial relationship, and it just seems like a natural progression of that relationship. But yes, as far as involving a banker, it goes back to, do you think it's the right time? A lot of business owners will get inbound calls or a partner that says, oh, we should buy you, and that sort of thing. But you'll know if it's the right time. But yes, that's when you would involve a banker and say, hey, this party has suggested that they should buy us. And we would probe some questions. Who at that party? Was it corporate development, or was it the salesperson or the business development person, or at what level in the organization has it risen, so that to gauge the seriousness of that inquiry. And then we would want to chat with you about, is this the right time? Do you want to exit the business? And are you concerned about confidentiality? And would you like to go run a process? What is your business worth? I think those are a lot of questions that we would ask of you, not to dodge it, but we do see a lot, especially with private equity. There's a lot of outreach to business owners. And that doesn't necessarily mean that you should stop what you're doing and focus on this inbound, because you're trying to grow a business. And one of the most distracting things you can do as a business owner is take a lot of inbounds super seriously and spend a lot of time and give information to these people, whether it's a strategic or a private equity, because if it's not time to sell, it's not time to sell.
I mean, as the potential buyer, I'm going to try to convince you not to call him and not run through. So I would say, don't listen to the potential buyer, right? Go call him, because you're going to get a better deal. I mean, we see a lot of folks where we've had strategic relationships, they've not gone and got advisors, and they do a very bad job of running the process, and it leads to us getting the company for a lot less than we probably would have had to pay for it. So call him.
Thank you.
Just talk about the human capital part of these transactions. Key employees, staffing. You want to keep it confidential, and then word comes out you're selling. How do you deal with that in a transaction like this? I'm just curious.
Well, I mean, I'll react. I mean, there's usually a core team of folks that are in the know in the transaction. That same set of folks, especially the key executives, are usually incentivized to stay to the end of the transaction. That could be in a number of forms, change of control bonuses or otherwise. They're often participants in the cap table, so they're heavily incentivized to get the deal done themselves. Post-closing retention is a different deal, and I think a lot of sellers, at least in my experience, particularly founder-based sellers, have this idea that they're going to pre-bake the employment arrangement for their touted CEO and CFO into the future of the buyer, and that the buyers are going to want that. And I think sometimes you have to kind of say, well, when they buy the company, they're going to do whatever they want. They may incentivize that person to stick around through a post-closing retention program, but they're also going to want flexibility. And so don't make them, don't make it too difficult for a buyer to digest whatever the tenure of your relationship is with your employees.
We often see business owners have a transaction pool, to Mark's point, that is dog-eared for maybe senior people, but also people with long tenure who have been there and really been there through the ugliness and helped you build the business. And so we see that sort of thing. And then as far as confidentiality goes, we often say the message to employees who get wind of it for some reason, because as you're gathering a lot of odd data and diligence that is not normal course in the operations of the business, people perk up. And so often it is we're looking at getting a line of credit and expanding our line of credit and potentially looking at raising capital to continue to grow. And that seems to be the less frightening message to employees.
Yeah, it's hard. I mean, right, in our deal, I think 2 or 3 times when we were in the middle of the process, there were leaks around it, and we had to go through halting trading, we had to go through FINRA requests because people were trading on news, trying to figure out where that news is coming from. We have a very small deal team, they have a very small deal team, so trying to figure out how leaks are happening, having to deal with all-hand employee meetings where you've got thousands of people who are asking you questions, where you're on investor calls or asking you questions. So it's a difficult environment.
Why don't we do 3 or 4 more questions, if that's okay, Brad? And then we'll have a reception. You can ask all these questions to these people directly at the reception as well, and I would love to continue the dialogue. So why don't we go in the back first? Okay.
So just kind of going back to the AI conversation and the ability of these AI technologies going through contracts and pulling out those provisions that are beneficial or hurtful to a buyer or seller. What extent, if any, do you think that AI is able to completely replace that discretion of a lawyer and the ability of a lawyer to kind of look at those contracts in a unique way that AI can or cannot replace, keeping in mind that there are students in their room with job needs and debt?
So you have talked about certain protection mechanisms like for buyers or sellers. So I wanted to know in what situations the buyers are most likely to use those protections for any deals, or even the sellers in what situations they don't want those protection mechanisms for the acquirers.
Thanks, Brad. Really quickly, I don't want you guys to dive in too deep, but it's I think a really important question going back to the FDI comments you made, Chris, and anybody else on the panel. In this sort of coming age of state-sponsored capitalism and circling the wagons a little bit, you mentioned the Homeland Security process. Just talk for a minute contextually about where things used to be and where they're going in that regard, sort of macro level, if you can.
I'll take the last one first, because there's an election coming up, and I think that's basically what you're asking, is the nationalism that's pervasive throughout not only the United States, but elsewhere in the world. Yeah, I would say that the regimes are getting tighter and tighter and tighter, and every country is becoming more sophisticated to be able to protect its own defense industry in particular, and other privacy of its employees. And these regimes will proliferate, and this will become an incredibly complicated web of foreign investment regimes throughout the world in the next 10 years. Why don't we handle the AI one? Eric, you're in a tech business. What do you think? How long until AI replaces me?
It's already there.
All right, I'm replaced.
No, I mean, we're already doing that today, right? I mean, but I wouldn't look at it as replacing it. It's freeing up those people to do something else, right? So, and we have people on our team who, right, so we get somewhere around 5,000 to 7,000 contracts to review every single year. We have, I was looking at the data yesterday, and 70% of our vendor agreements are below $50,000, right? It's not worth our attorney's time to spend time on those things. So where you're trying to strategically use the AI is where you don't need to be putting the human capital that's not making a ton of difference. So I'd rather put them and heavily negotiate the 30% that are at the top of the pile than doing the lower 70%. So we're already using AI tools today to ingest contracts, basically spit out where they think the problematic areas of those, and we simply review those problematic areas and then negotiate from there, as opposed to reading the full contract. So like on NDAs, for example, if we get a third-party NDA and everything in that NDA is mutual, I'm probably okay with it, right? As long as there's no feedback, residuals, those type of things, clauses in there. So we kind of have a 5-check system that we run through AI and machine learning and say, if it doesn't have those things, let's sign it and move on.
Does anybody want to tackle the second one? I might need more context if I need to tackle it because I wasn't sure of the question.
Be more willing to have the protections, like, yeah, so I wanted to know, like, are there any certain context when the buyer would be more willing to, like, incorporate those protection mechanisms so that they can get out of the deal?
Oh, okay. So
And-
the question, I think, is a buyer wants flexibility to get out of a transaction between signing and closing, and what are those circumstances? The buyers would love to do that. Sellers and Adam and me won't let that happen. So we will lock this thing up as much as you can. But there are outs to a contract. So if you don't get antitrust clearance, you're not going to have to close the contract. If there's other prohibitions to close the contracts, there are things called financing contingencies and financing outs, and maybe you have to pay a penalty to do it. But it's a very limited set of things. You're done analyzing the company when you sign the M&A agreement. You don't get more optionality as a buyer. You're going to write the check.
Seller would have to be pretty desperate.
Yeah, right. Great. Well, first of all, I want to thank everybody, and Brad has a word here.
Yeah, I'll say. A lot of students here, many of whom are part of a program where the transactional IQ, being able to follow a high-level discussion like this, is just part of what we're doing, not just at the law school, but over in the business school and really across campus. I strongly encourage the entrepreneurs, the professionals, the business people, go find a student, please, at the reception, meet him or her, and share the benefit of your insight. That's one of the best things that we get out of this. One of my favorite cartoons from the last couple of years is Ralph Rex the Internet. Anyone seen that? So I think that a great cartoon or animated movie operates at two levels. Like one, for the kids and the entry level, there's a series of themes and jokes and material for them. But it's so clever to run an entire second set of stories for the adults in the room with a different set of themes, a different set of slide jokes. This panel was just like that to me, where you guys, you made it accessible for the entry level, but a lot of depth for the experts as well. Please help me give a warm thank you to Mark and our panel. It was great.
So I think there's a reception. I think it's right out here. We'll hold it right after this. Hopefully we didn't cut into our time for the reception by going a little over. Thank you so much. As you can tell, everybody up here is passionate about this topic. If you want more content, more context, you have questions, just reach out to any of us. Love to get you on mailing lists and just get you involved in the M&A community.